Borrowing costs are up, hitting levels not seen in decades, and particularly on long-term bonds. This is creating a headache for investors and for governments around the globe. From mortgages to car loans, the cost of our borrowing is often based on long-dated bonds. It's also what governments pay for their long-term borrowing. Now we're seeing investors demand extra compensation for holding those bonds, with sticky inflation and wide budget deficits front of mind. Structural forces like demographics and geopolitical rifts are also driving up borrowing costs behind the scenes. Yields on 30-year treasuries are within a whisker of the 5% mark, a level last reached in July. Meanwhile, UK 30-year rates have hit levels last recorded in 1998. Traders buy bonds based on their risk and their return, and the longer there is before a bond matures, the more opportunity there is for something to go wrong, and this means that investors demand more compensation. Governments across the world loaded up on cheap debt after the global financial crisis in 2008, and then borrowed even more to cope with COVID lockdowns and the recessions that went with them. A surge in inflation and in interest rates since the pandemic has made borrowing on that scale extremely difficult to sustain, and there are structural forces which are likely to push rates even higher. The concern is that if bond yields stay high and governments fail to get their fiscal houses in order, the cost of servicing those debts will just keep climbing.